So today's webinar is going to be a very simple one, and we're going to look at just very few strategies that are very suitable for new traders. So the first one, which I keep mentioning here before I start off, I want to mention something very clear to make sure that you understand exactly what I'm saying. That the very first strategy, other than the one which I'm going to mention here, is that you need to learn how to control a risk first of all. That's the most important thing. That anytime you open a chart, before you trigger any trade, just ensure that your risk is taken into account. That's the most important thing. So we don't want a case where you trade, even if you have a very good strategy, you have to ensure that your risk is controlled properly. That's the first thing. Have a very good risk to reward ratio. So before you look at any, even if somebody tells you that there's a strategy that works 95%, 100% of the time, that strategy must have a very proper risk management. So the first thing towards getting a good strategy is ensuring that you have a stop loss and a take profit that is reasonable. That's the first thing. Ensure you have a stop loss and a take profit that is very reasonable. So the first strategy I'm going to mention here is that I'm going to look at breakout as a strategy. Then I'm also going to look at false breakout as a strategy and it's wrong. Then I'm going to look at other strategies combined using indicators. So the first one is breakout. So what breakout means is price actually going above a level and then retracing back to the same level so that you can pick a trade in that direction. And what that means is this. We have a line, our screen is cleared. We have this. The red lines you're seeing, I'm down as place them. So anytime you have this as a resistance, the upper line, price moves towards that level and then retraces back slightly. Then it comes back again to the same level. And then it retraces back to the same level. So that level becomes a very good resistance, and then price comes out from it and it traces back to the same point. This level becomes a very good resistance. So ordinarily, somebody will find themselves selling from that resistance and then buying from the lower one, which acts as a support. We have that. Then price proceeds down. Then it comes back, same place. So the upper one, which is this, is a very good place to look for a sell from. Anytime the price comes back to the same level after the first bounce from it, is a sell. So we'll technically look for a sell from this point here, the second one, and then we'll look for a sell here, and then we'll also look for a sell from this point here. But then assuming you pick a sell from this point, then something like this happens, that the price goes up and even closes above the entire level. It is this move from below up to the upper one that's called a breakout. So as a beginner trader, don't buy when the price is here. This is out of greed. It's a late entry. Like somebody enters because the price has just gone above a level, you find yourself buying just because price is above this level. So instead of buying there, wait for price to retrace back up to this level here. Wait for price to come back up to that support, then pick a buy from that support to the upper side. So instead, the same place where you're buying, selling before, selling is the exact same place that you're going to look for a buy from. So rule number one, if you are not selling from the same level before, don't find yourself buying from that level. And if you are not buying from a level before, don't find yourself selling from that level. So technically, somebody would buy it there, there's a sell, is a sell. So you are buying here not only because this level is a support, but it's because the same level was used as a sell place before. That's what I'm trying to say, that you don't find yourself buying at a level that is the very first time you're using it. And if there was no opposite trade in that level, around that level previously, don't find yourself trading there. So we'll buy it there and let trade run. The first take profit, somebody will take profit. This is out of fear because they're afraid that this may be another resistance, that price can bounce off from this level. But from my own experience, if you have a very good level on the lower end like this, then price goes above it and forms this, we are likely going to break above this level. And you will see something like that. After price going above a level, it may retrace back to the same level before we'll be able to pick it even higher. So instead of selling, if you successfully manage to buy it around this level, don't take profit here. This is out of fear. Wait for price to continue up, then retrace back, then pick another buy even higher to the upper side. So this is one strategy. It's called a breakout. Anytime price goes above a level which is significant, the same place will be used for opposite trades. We look at a main chart. We have this level here. So if you look at this, is a 4-hour chart, and this is exactly opposite what we mentioned. This is like in a bearish case. We have this level here. Price was moving down, and then there was a support here. So you come and mark that as a support. Then price continued up, it came back as a support, continued up, it came back as a support, and then somehow price opened here, then closed below. So it is this move that we now call a breakout. And when price gets back to the same level, these are the places to look for trade from. You need to look for a trade, a sell there, and then you also look for a sell there, and then you also look for a sell when the price is here. So whatever the price has done, that the price has moved from just one candle from this point to this point, remains insignificant based on what you're saying. That when the price goes above a level, unless this candle closes above this zone, it remains insignificant. We are still sellers. So the big candle you're seeing, which has opened here and is currently somewhere here, it just shows that there's a big move to the upper side, but it does not indicate that this level is going to be broken. So we don't want to anticipate that the fact that this candle is big means that it's going to break above this level. No, it has to close above for us to say that price has actually broken that level. So as it is, we don't recommend that you look for a sell. This is a very good one. We don't recommend look for a buy. It's a very, very good sell. We have a level, a support which has been broken. There's a retracement. It continued down, same place, continued down, the same place, and the same thing will apply here. So in case price comes back up to this level here, we'll definitely look for a sell. So this is a very good support, and if price breaks below it, then we'll wait for a retracement before we can pick a sell even lower. So this is the correct place to look for a sell for me. If you are trading this pair correctly, be sure to look for a sell below this level, 1.03882. Be sure to look for a sell. So this is what I'm saying, that anytime you have a level and price goes below it, the reason you're selling here is not only because this is a sell, but it's because the same place we've bought from, and probably in the past was the same place where somebody else bought from. So this is another example here, a very good support which has been broken. Have that. Then you also have this. So this is a support, there's a break below, it came back, retracement, it went down, back, continued down, and then it came back to the same place. and a very good place to sell from. So if you are looking at this pair here, then this is the correct place to sell from. This is not very, very good, but it's a very good example. Some cases, price may break above a level or below a level, but then instead of continuing that direction, it actually goes the opposite. So the same is true here. You can see that we had this as a resistance, then price opened below, it went up and closed above, then we wanted price to retrace back, which it did, but then instead of continuing upwards, it actually pulled back to the lower side. So this one is a bad one. Like the entire move above and then back below is actually a false breakout. The entire move which we saw, which is this is actually a false breakout. It's a false breakout. It does not indicate anything. It means that we attempted to get back up, but then somehow we came down. If you check the webinar which you did previously on false breakout, you will realize that we said that anytime there's a false breakout above a level or below a level, the best entry is when price retraces the very first time back to the same level, which is this. So after this false breakout, the first retracement, the correct place to look for a sell from. So this is after that false breakout is when you look for a sell immediately. Hope that makes sense. Another example of this one, very good one. The same place has been used previously as a resistance. We have this as support, yeah, a support, yeah, and then we have a very good resistance. I mean, a resistance which has been broken. So the fact that price gapped from this point to this point, that is called it's like a breakout. If you check a higher time frame, this was like one big candle opening, weekly candle. It opened here and closed somewhere here. So it was one big candle, it's not a gap on a higher time frame. If you are checking weekly, because this one stands for a week, price opened here and then it went up to this. So the gap you're seeing here is only on the 4 hours or on a lesser time frame, or from the daily downwards. But on a higher time frame, we're actually one big candle which is opening below and closing above. So after this breakout, first retracement, continued up, and the next retracement, look for a buy from that point. So we are buying here not only because this is support or because it has been used previously, but because this level has been used previously as sell places for opposite trades. So before you pick a sell or a buy in any place, ensure that that level was used previously for an opposite trade. Let's check another example. We have this as support. Very good support there. Support. A support here. Support, then price went below, but somehow it didn't come back to the same level perfectly. So this was not a good one. It's not a good one. We have another level on top here. So we have a support. There's a very good support here. Then price went down. It came back as a resistance. Then it continued down. Then it came back as a resistance. And then it continued down. And then it came back as a resistance. So basically, these are the places you ought to be looking for a sell from. The lines where I'm having my arrows, these are the places you ought to have been looking for a sell from. So you're not selling here because this was a resistance previously, but it's because the same place was a support and we used it for an opposite trade. That's the main reason why you're selling. So that is one thing. If you want to trade correctly, if this is a resistance, the same place must have been a support. And if this is a support for a good buy, the same place must have been used previously as a resistance. So if you're looking at this is a resistance, and then you find that the same place is a support, same place must have been used previously for an opposite trade and for an opposite signal. So we check another symbol. Let's check NZD. So then another thing, if you want to do this correctly, ensure you understand what is happening on the highest time frame. If you have a level, it's a very good monthly chart. You can see that from 2015 until now, price has been using this level as a support. Yeah, we have price consolidating above this level, a support. There's a support. So the entire year, this was a support 2016, and then it continued up. Then 2018, the same place was a support. Only this year we went below it. So this is a sell. Now that the price has gone below this level, we want a retracement back, perfect retracement. Then we can pick a sell even further to the lower side. There's also this. We also have this trend line here. These are just to help you understand exactly what is happening. That you can see we are actually making lower lows, lower highs at resistance, which is the highest high so far. It went down, came back up, a higher high, continued down, came back as a resistance, higher high, a lower high, sorry, then it continued down, it came back even a lower high. So anytime you find this, that the price is making lower highs, but there's a base which is holding, just know there are chances we are breaking below it. So if price fails to go below, if it fails to continue to the lower side, and instead it comes back up, then the correct place to buy it from is when it retraces back to this level. And I don't recommend a buy because we are still making lower lows. The correct place to buy it from is when price does that, but only up to this level, up to that trend line. So this is the correct place. You either buy it here, or you wait for price to bounce off from this level, from the top. Wait for price to bounce off from that level. So wait for price to bounce off that level there, so that you can sell it at the lowest risk possible. So another thing, the price may break above this level. If price closes above this trend line, then that means we are now completely to the upper side. So this is one thing. This is like a very big triangle. Informing this is the base of the, and this is the diagonal. Call it, but this is like what do you call it? Hypotenuse, something, I don't know. But we have a level here, a very good trend line, and then you also have a very good support. So if you want to trade this correctly, you either buy it when the price is around the base, which is this, or you sell it when the price is there, or wait for price to break above so that you buy it, or for price to break below, which it has done already, so that you can sell it even further to the lower side. As it is at the moment, this is a sell, but only if price pulls back up to this level. So another very good strategy, other than the one I've mentioned, is the one where you combine stochastic and RSI. So far I don't like trading so much using indicators, but I'm going to talk about a very good one which is very significant, which you can use for your own trades. So we have this. The indicators which I've mentioned are called oscillators. This. We'll go to insert, then oscillators, then we have RSI, relative strength index. So RSI stands for relative strength index. I'm going to make these colors so that we're able to see the levels. The one on the lower side, this is called relative strength index. So if you are looking at this chart correctly, you will notice that I'm having another window below, which is this. What it stands for is RSI, relative strength index. So how it works is that there are two levels. We have the first one above, which is 70. Then we have the next one, which is 30. anything below 30 stands for what has been oversold, and anything above 70 stands for what has been overbought. So if you check this properly, we only have overbought on very few cases. There's this. Just a second. This one. There is this overbought. There is this overbought. There is this overbought. Then we also have this as overbought. Then there is this as oversold. There is this as oversold. And then there is this which is overbought. So what this means is this, that anytime you have price above, you have the stochastic, the RSI above 70, which is here. That means the particular symbol which you're trading is actually been overbought. It is time to start looking for a sell. And anytime, this is the place that marks overbought. But anytime you have the same RSI below 30, that stands for oversold, and it means it is time to start looking for a buy. So when you have this, when you have the stochastic below 30, that means wherever the price is, which is at this point here, it has been oversold. That means it's the time to start looking for a buy. The same thing is true for this point here. Yeah. You have price below, price is around this point, and then at the same time, the stochastic is below 30. That means it's oversold, that you're supposed to look for a buy. So the only way to confirm that this is actually a buy is to add another indicator, so that you don't find yourself trading one indicator with price. Anytime if you have price below 30, and then you draw a line there, then you notice that there's a very good support. That is probably a good buy. So you don't buy one thing. Don't buy just because the price is oversold or overbought. Combine that with price action. And if you don't understand price action very well, combine that with another indicator, which means that simply means that if you have this, if I have a support here as a buy, if this is a very good support and the indicator is also showing me oversold, I'll attach the last indicator, which is RSI, relative strength index. Stochastic. Sorry. So I'll attach this also. It may appear that we are congesting our charts, but it's really good for us to do that. It helps you weed out wrong trades and only get the correct ones. So also this one, you have two levels. We have this, the upper line, and then you also have the lower line, which is 20. So anytime you have the stochastic below 30, then you have the other indicator below 20, then that confirms a buy. It confirms that the trend is up. So there are very few cases that happens, but anytime they happen, it's always a very good time to look for a trade. Like we have this, the stochastic was above 30, above 80. At the same time, the RSI was above 80, and then so what happened? The price actually went down. So this combination is very good. It's really good. So as I was saying, we have this level, have this, you have the indicator being above 70, and then the stochastic is above 80. So that is always the correct time to look for a sell. Anytime you have these two above, they're showing overbought, then that's the correct time to look for a sell. And anytime you have both of them showing you oversold, then that's the correct time to look for a sell. So technically, you could have sold here. Immediately when this happened, you could have picked a sell. Let's check another good example. We also have this one. Yeah. We have this. You can see the stochastic was massively below 20, and then RSI just some few, no, it was around 30. This is 30 years. So this is the correct time to look for a sell form. We also have this one. RSI was completely below 30, and then stochastic was below 20. So that's the correct time to look for a buy. We also have this. A good example, we have this. So you will notice that anytime you have the stochastic showing you that the price, showing you above 80 and then the RSI is also above 70, then price tends to go that direction massively. So that's the time to look for a sell from. You don't just sell because there's a level here. No, no, no. Confirm with the stochastics, the indicator. That's why the indicators are there. They try to show you exactly certain things which you cannot see by your own eyes. We also have this. Stochastic is above, RSI is above 70, and the stochastic is above 80. That's a sell. So it didn't go short massively, but somehow it went downwards. Also have this. We have this one. Yeah. Below 20, below 20, 30, and the stochastic is below 20. So we look for a sell, a buy when this happens. Have that, and then also look for a buy here. That is how it's done. So anytime you have the price below, the stochastic is showing you below 20, and then RSI is below 30, then that's the place to look for a buy from. The same thing. Yeah. Below 30, then below 20, a very good buy. This. The one of this one. Yeah. Below 30, below 20. Very good place to look for a buy from. Another one. This one. So that's, you can see that we have the stochastic above 80, but the RSI is in between 70 and 30. So that's not a good trade. So have the one. RSI is below 30, stochastic is below 20. A very good buy. So you could have technically bought it here. You have bought it when this happened. So your definition of this one of stochastic, however, how you use your stochastics, only you can truly understand. But the correct way is the way I'm mentioning, that you need to wait for it to go below 20, and also the next one also to go below 20 so that you can buy it. Or both of them should go above 80 so that you can pick a sell. There is this. Yeah. So in some cases you may enter trade, but instead of price continuing the direction you expect, it actually goes opposite. Just know that such things will happen. Like in this case, we have RSI is below 20, below 30, and then stochastic is also below 20. Then instead of price continuing upwards, it actually pulled back to the lower side. So this was a loss on your side, but ensure you have a very good stop loss for such cases, so that you don't find yourself buying and your stop loss is here, then eventually price comes and hits it. Have your stop loss slightly below the lowest low, somewhere there. So if you are trading this and you bought it there and price goes below that line, that money, that's the correct rate. It's better you lose something small than to lose something big in the hope that the price is going to get to your way. There is also this one. You can see the price is above. The RSI is above 70 and stochastics was above 80. So this was a very good sell, and if you sold it, eventually your price went your way. We also have this one. RSI is above 70, stochastic is also above 80. So this was a good sell. Have this RSI above 70, then stochastic is above 80. So this was a good sell also. Anytime you have this, that both of them are oversold or both of them are overbought, then that's the correct place to look for a trade from. You need to start looking for a trade at that point immediately. So overbought means you're supposed to sell. Oversold means you're supposed to buy. This to head to the upper side. We also have this. RSI is above 70, stochastic is above 80. So that's a sign that you supposed to sell. You could have sold it. Yeah. So if you sold it, it actually went down slightly before eventually heading upwards. But if you are taking profits also early, these are good. It actually went your way. You took your profits before price went the other way. So I hope you've understood what we mentioned here from the start. The very first one is risk management. That's the very first thing. That's the very first strategy. And the next one is you need to wait for places to be broken. Look for key levels and for price to either break above or below such levels. And then also monitor false breakouts. Then the last one which I've mentioned is using these two indicators, RSI, stochastic. So thank you very much. That should bring us to the end. We meet again tomorrow at the same time.